The Hedgeless Horseman here. It's May the 14th, 2023. I recently did a video, but unfortunately I think the mic setting was off, so it actually didn't record any audio, so I had to take that down. I won't go over the exact same things, because it feels a bit sucky doing the exact thing for 50 minutes again, but I'll try to get some Copium, common Senseium, and I'll look at some juniors in this one. Well, first of all, I think this chart I did here, I posted this a few months ago, perhaps, or a couple of months ago. Is basically, the title of this is Periods When I Look Wrong. Obviously it's a pretty crude chart, but I mean the point being really that the rallies in this sector tend to be a lot more concentrated in time and quite violent. More so typically than the bear periods, for example. I mean, one example is the huge bear in Bear Creek Mining, fitting name, since 2011. Extremely long, and of course you had these violent rallies. I mean, it's retracing this here, retraced all the way back here. I mean, that's 2014 to levels seen in 2011. So I mean, that happened over only a few months, and you can obviously see this legendary 2015-16 rally. I mean, it retraced to levels also seen like 2011 actually, 2011, and that was in a very short time period, 5-6 months. The thing is, as always, you have no idea when it will happen. Well, you have no idea when the pendulum will swing to, from extreme undervaluation to extreme overvaluation. Maybe this is a fair value somewhere around here, maybe lower, who knows. I mean, obviously depends on each company. I mean, some might say that, hey, Bear Creek Mining really has no significant long-term value, so it might be a bit undervalued, or maybe not even undervalued at all. It all depends. I mean, if gold would shoot up to $3,000 tomorrow, obviously I think they were producing mine now. Obviously that would have huge implications, and they would actually be making a lot of money all of a sudden. So we don't know. I mean, we never know what the true value is of anything, not a single company, because we don't know what's exactly going to happen with the company, what's exactly going to happen with the metals, etc., etc. But thankfully, like Pierre Lassonde has said, that this sector is so easy because it's, I mean, well, he basically said because it goes up and then it goes down, then it goes up, then it goes down again, forever and ever and ever. Has been so since the dawn of time, which we can attribute to, I mean, it's basically sentiment at work, especially that creates these huge swings. Because okay, if the market is always right, why didn't the market here price in that the quote value according to efficient market would be down here just a year later? That makes little sense. And if you look at it, I mean, it's not that it's uncommon. I mean, the value of Bear Creek didn't suddenly go from 1.73 to 3.4. It didn't double in value over these 2-3 months. Certainly not. But sentiment, greed and fear did that, and momentum trading did that. And I mean, I guess the point of this short is that this sector is extremely volatile. It sucks more than there's more bad times than good times if we're talking about price trends. Obviously, one could also say that if you understand that sentiment always changes and it's endless cycle of ups and downs, that obviously could be a good thing, because if you have prolonged periods where you can buy this sector at extreme cheap levels, you can get a lot of money in before the next inevitable upturn. This is, here we have, several months, half a year, 1 year. If you just look at how high it went from here, any buy all the way up and actually all the way down here, obviously, since it was so cheap. Literally any buy would be in the green, and it would be, pretty solid returns, especially from this level. That's $3.8 too. So almost 100% return. Not extreme returns from this level, perhaps in 2018. Well, in 2 years, that's actually pretty good returns. The lower it went, returns down here, absurd. Returns down here, absurd, because it's not only the actual return, it's also, how long it took. But the good thing about this sector, an inevitably cyclical sector, is that even if you're quote wrong, you're too early, this was cheap but it got cheaper for a long time, that doesn't really matter that much, because since we know by definition no downtrend lasts forever, so this was, let's say this was day number X in this downtrend. This here was day number X plus 200 days. And down here it was X plus 400 days. So the only thing we know from day X plus 398 days is that if it's down tomorrow, so it's gone 399 days since this point in time, the downtrend, we know that it's 1 day closer to the last day of a down cycle. Which, as I said, means that, and I've said this countless times, means that since it starts from a lower level, because it's another day down, the returns will be higher. And they will come quicker. Because one day, the best day is the last day of the downtrend. When the downtrend has continued for as long as the maximum amount of time, which we only know in hindsight, and the return are the highest, because that is the literal bottom. So you get, that would be the day of the bottom, and if you count this return from here to here, that's the highest in, since this period, actually lower than this period. And lo and behold, you're closer to the next cyclical top. So highest absolute returns in the last several years, and the quickest payoff. So that's why I keep saying that buying in a downtrend, buying becomes exponentially better than holding, and holding is exponentially better than selling. It is the costliest sell or sale anybody could do would obviously be the day of the last day of the downturn, which nobody knows. We just know that for any additional day down, it's getting closer and closer and closer, and the returns will be higher and quicker. So even if you start buying here, let's say, and you're like, I thought it would turn around. Personally, I thought this was the bottom. We had already reached an extreme level. In hindsight, we learned that that was not the bottom. But thankfully, I buy more the lower this sector goes. I get greedy. And I didn't, sell out here and then buy back here, for example, because now everybody's, agree that the bull has started, because then you would have a starting price here and then you'd have a quick paper loss. But even if you did that, I mean, the thankful thing about something that is inevitable, and I'm not talking about Bear Creek specifically, I mean this company might go bankrupt, but the entire junior sector will not be bankrupt, because in that case we don't have a mining sector, in that case we don't have a civilization, and in that case it doesn't matter what you own, because Apple is not gonna be worth a lot if there's no civilization around. So again, the risks are, well, the idea of, hey, you know, it can go down forever, I mean, it's irrational, and the funny part is that even if it were to happen, it wouldn't matter. It literally wouldn't matter. So that's not even a bet, I mean, that's not even a risk worth thinking about, because it doesn't matter if that were to happen. But my point is that regardless when you bought in, by definition, buying becomes better the longer a downtrend has persisted and the lower the price goes. That's the whole point. So let's say you bought in here and just hold and don't buy in, and then it, you know, goes higher eventually. I mean, if you sell down here, you obviously, in my opinion, made a huge mistake, because you bought at a higher price and sold at a lower price and lower valuation. You took a worse opportunity. You bought a worse opportunity than sold as the opportunity was exponentially better. That's a mistake in itself. But I mean, even if you got in here and you were able to, I don't know, add 10% to your portfolio, since you understand that the buying becomes exponentially better. The buy here is much better than the buy here, and better than the buys here, yada yada yada. And this buy would be better than the buy here, for example, because more time has passed in this, well, if we can call this a downtrend. So it's closer to an upturn anyway, and the price is the same, assuming value is unchanged, etc. This is better than this simply because more time has passed. Same here, that this buy is better than this buy because it's closer to the inevitable upturn. So again, that makes, I mean, that is super common sense. Super common sense. Since we know that no trend lasts forever, this sector will never go up forever, never go down forever. So the longer it has gone up, the closer it is to going down big time. The longer it has gone down big time, the closer it is to going up big time. So by definition, buys become better. Out of simply common sense and how you know, psychology, etc. works. So we should always get increasingly more bullish the longer the downtrend has persisted. Obviously that is not the case for most people. 95% of people see it the complete opposite. They start giving up because they have not seen any evidence. And I know a lot of people, probably quite a few that are listening to this video, you bought in here. Why? Because, okay, recent past was good. This sector was, quote, working. People were making money on paper. And you don't want to miss out, because everybody up here obviously are saying that, hey, now, you know, now the big bull has started, etc. Even though it's like, by definition, much better buy down here. And we know traders who sold this Corona flash crash. Again, nothing about valuation or anything like that. They are following the trend. Obviously, this is a horrible trend, and here one could say this broke the low. Same here. It's like, yeah, massive support or many times support levels, and then that broke. So people get, you know, more and more bearish, and people are more and more bearish. I'm sitting here. It's like, I see it as a good sign when it starts to feel like this sector is never gonna go up. That is an incredibly good sign that something is about to happen. When everybody has given up hope that this could ever go up, meaning when max amount of people have in their way of thinking concluded that this sector is not worth it, you should go and find another sector. That's when people sell for the worst reasons ever, because they don't look at valuation anymore, obviously. They might have bought something here that was cheap, and they know it's cheap, but they sell here, or buy here and sell here. Not because it's not cheap, because they can't take it anymore. That's the thing. When we run out of sellers willing to sell for irrational reasons, then by definition there is no downside left. Because imagine a scenario where every junior share held today had owners of said stock that had already decided, I will never sell a stock in these juniors at a lower price than today. By definition, that must be a bottom, because nobody would put up their shares for sale at a lower price. So it is impossible for price to go down, because nobody is putting their shares up for sale at a lower price. I mean, that's literally what a bottom is. You run out of... There was nobody willing to sell at an even lower level than this. That's why we had a bottom. Because if somebody was okay to sell Bear Creek Mining for an even cheaper price, they would have. But nobody did. And then momentum got going, because obviously if there's nobody selling, if you have a stock, no sells available at a lower price. So the only, let's say there's bids in, there are asks, and asks are obviously higher because nobody's willing to part with a lower price, at a lower price. By definition, the only way for the direction of the stock price is up. Because if you have a, what is the bid here? Last price, 0.66. Let's say there are some bids here in Bear Creek Mining at 0.66. But nobody who owns shares are selling to that potential buyer, because they do not, they've decided they will not part. They will not sell their shares at 0.66 or lower. So you will never see those bids hit. And the only way for price to change is if somebody new buys from a seller at a higher price. So when the longer this takes, the longer these downtrends persist, the more irrational reasons people will sell for. So the longer the downtrend, the more stupid reasons people will find to sell. That's why when this sector gets cheap and stays cheap, it typically gets even cheaper and stays cheaper for a long time. But all of a sudden it can switch. Okay, nobody was willing to sell a share below this level. Then the only way is up. That's obviously also a reason why the longer this takes, the longer the downtrend is, the longer people get frustrated and we can't sell, the closer we are to the inevitable uptrend. Because there will be a day when nobody is willing to part with whatever shares at that particular price or lower. And like I said, most people, yes, they buy here, but that's not the main mistake people do. Buying high, I mean, if it's the first time you're in the markets, etc., you just started investing, nobody can really expect anybody to be a full-blown contrarian, shark, stone cold killer. I wouldn't expect that out of anyone. I mean, I started buying here when I thought it was cheap. But if I had been more aware of the sector back here, I might have bought in here and they would have suffered this. So I don't know, how much was luck, let's say. I knew it was cheap and I just kept buying. But that was, again, my best decisions from this period was not buying here. It was buying every day it went further down. Because if I hadn't done that, if I hadn't averaged down, and I would just be sitting at a 54% loss, because I had minus 54% down here from this point. I bought all the way down. One day the bottom was in. I had no idea that it would be the bottom. We just found that out much later. So if it's impossible to know when a bottom is in, but you know the bottom is getting closer and the returns are getting higher, it makes it pretty simple what to do. The longer this is down here, by definition of how cycles work, buys go exponentially. The value of buying increases exponentially relative to holding, and holding to selling. This was the worst sell and the best buy, because it was the longest period of time that the downturn had continued, and it was the lowest price. So if a stock I like keeps on going down, I know it's one day closer to the next upturn, and the returns will be higher on average. Just that, having a firm grasp of that common sense alone is the only thing personally I think you need to beat this sector and actually make a lot of money over time. But as you can see here, on a short-term basis, there's no way you can really have a big edge. The only way to play this short, the only edge, when we're this low, it says nothing about the next day, week, or month. This was already extremely low, but it went lower for X amount of months. We only know that the lower it goes, the higher the future returns will be. And it's like in 2000, excuse me, 2011. Let's say this was already overvalued. It kept on going higher. So what does that mean? We can't know when the top is in, but we know if this wasn't the top, then this is closer to the top, and if this wasn't the top, this is closer to the top, and this is closer to the top, this is closer all the way to the top is in, which we'll find out much later. And every buy on the way down had exponentially higher compounding. Because from this to here, that's a nice return, and in a short period, from here to here, even a shorter time period, even higher returns, and the highest returns are when it's the last day of the downtrend, and the returns are absolutely the highest. You don't need market timing at all, really. But if you have some kind of grasp when it's cheap and when it's not, if you think the sector is cheap and it goes down, it just means that, hey, automatically it's a better buy today than yesterday because it's cheaper. That's all you need to know. But like most people, and I wrote about this in an article I made, which I encourage you to read, people try to make their investment strategy as complex as possible. That's how it feels like. It's, following endless amount of macro noise, like price of metals, which we've already shown that if this was the short, this was 2011 in Bear Creek. Gold would be equivalent to being up here because it's around 2000. Bear Creek is down here. And a lot of juniors are 50% off their 52 weeks highs, even though gold is at close to all-time highs. So we can also conclude that even the metal prices, if you're in mining, they can be relatively irrelevant in a given time frame. So even that, which it doesn't make too much sense, obviously, because hey, that's the actual product they use. It's like doesn't really make much sense. I mean, if you have a car dealership or you're assembling cars, you're an explorer in a way. If you're assembling cars and you see the price of cars go up and up and are near all-time highs, obviously the expected value, one could say, should be going up for the cars you're producing. But with that said, also, in some ways it makes sense, because what happens when gold or silver goes down 2%? Paper prices. Juniors typically go down in price. Why? I mean, when you think about it, if these gold and silver juniors will not have a mine in 5 to 15 years, what does it matter what the gold price did on a day 5 to 15 years ago from when they actually will be selling these metals? One could say it has absolutely no effect on value, because it's pretty much irrelevant what the price was 5 to 15 years ago. I mean, think about it. If I'm starting to sell cars today, is that the value of those cars affected by what the car prices were 5 to 15 years ago? Of course not. I wasn't selling cars back then. So that's the thing. It's like paper prices of metals is noise, really. At least from a value perspective, if you're an explorer, etc. I mean, they have effects of, like we know, I mean, it does change price of these juniors, even though it makes no sense that they really should, because they're nowhere near production. But it affects price, and since everybody else is trying to guess what the price tomorrow is going to be, it affects it even more. But in reality, that's all noise for a value investor. But everybody is a trader. 95% of people are traders, momentum traders, and they play the game, guess the price tomorrow of this security. Nobody right now in a high quality junior is selling because they think it's expensive. They are selling because they think somebody else is going to sell it and give it away even cheaper tomorrow. And that might be the case, even though it's already extremely cheap, but one day the bottom is in. So even if you started buying, if you even started your career up here, that doesn't mean, if let's say, if this might have been a bad buy, this is an even worse sell. You don't fix problems by making even worse mistakes. It's obviously a mistake to be selling juniors this cheap. Gold juniors or any junior, they never stay as cheap as they are right now forever. And they never stay as expensive as they did back here forever. I mean, at this point here, I remember silver juniors, they were, even producers, they were pricing in like $35 silver when silver might be at 28 or something like that. So you were paying up for an even better future that has yet to happen. So you were speculating. Now they're not even pricing in the metal prices of today. So value is below price. Here price was above current value. And it's like I say all the time, I can afford huge paper losses for extended periods of times, because I'm always 100% exposed from the bottom tick. I was 100% invested from here to here, 100% invested from here to here, 100% invested from here to here, because I never sell cheap. And I typically never sell. I just buy, and just increasingly buy as much as I can the lower it goes. And I think this is a quite interesting chart here. Volumes for the TSXV. Nobody's in this sector. So if you were a buyer up here, there were many other buyers. You were not a contrarian at all. Okay? Boom. and this was, I mean, volume had already picked up here as well. So if you were a buyer, because every trade is one buyer and one seller. So more buyers were active here than here. And since we know it probably was cheap, it means that very few had the fortitude to know it's cheap and buy. Otherwise price wouldn't have gone this low. Now we're at anemic levels of volume. Which again, to my point that when the last person has sold at a ridiculous level and there's nobody enough willing to sell shares in those companies, when all the dumb money is completely out, that is the last day of the downtrend. So one should not be selling down here. One should have not been selling down here. Again, speaking for the sector overall, what people did. That means there was still dumb money in. And of course some people sell because they need to, etc., etc. Still, by definition, I mean, if it's irrational to sell below, let's say below this line here, all the sales down here that are not for reasons that you need money, etc., is people making worse and worse mistakes because it's getting closer and closer to the uptrend and the returns are going higher. So by definition, you have to be dumber and dumber and dumber and dumber to sell. But obviously it's not about people being stupid really, it's emotional. That the longer it goes on, the lower it goes, the more pain people feel. They might have had the fortitude to sell here knowing it was cheap, but they couldn't stand it down here. So one could say when there's, the ratio of emotional buying, selling, the ratio emotional selling versus rational selling is going up, up, up. And one day they will all be out. Because, yeah, literally everyone who can't stand it have sold out. And given the volumes we're seeing, that means there are less and less trades happening, meaning there are less people inclined to sell and less people inclined to buy. So I would say that suggests, given the valuation levels, that that fewer and fewer longs are willing to part with their ownership of shares. So we're running out of dumb money. But there's still not enough momentum to actually get anyone to buy. So there's no new money coming in. Why? Because this sector is performing badly. Nobody is sitting in, I don't know, weed stocks, Dogecoin, whatever. They don't see a reason to buy if it's not going like this. This is when they see a reason to buy, because they're looking at this and projecting that it's going to go like this. So I would say we're running out of dumb money. Slowly but steadily. For every additional down day, we're running out of more dumb money. And one day the bottom will be in, then all of a sudden we get some upside momentum, and then it just, like it always happens, it just feeds on itself. So I mean, literally as a value investor, we're just front running that the inevitable upturn momentum is getting closer and closer, and the returns will be higher and higher the longer and lower this goes. So it makes, from that perspective, it makes buying an automatic decision, because we know that nothing lasts forever. And just interesting, I had a podcast on K Report on Friday, and Matthew, who's I think he's a trader, he posts a lot of short. I typically don't look at too many shorts, but he put up a very interesting short that if you look just at the moving averages of gold, for example, $2,000 gold today is similar to $465 gold in late 2015 if we're looking at moving averages. I find it quite interesting. I mean, if people think, oh, we're so high already, etc., etc., the price was reached equally much from the whatever moving average, 600 week, I guess. Well, this is a 600 week. I don't know exactly how this works, but point being that it's not as high as it seems. And you can see how far away from the moving, 600 week moving average prices went before they, had a blow off top. I mean, the funny part is the 2008-9 crash, it bottomed at this line, and we're not, we can see it here, but we're not even up to that line. We're at this line here. So it kind of gives some perspective, I think, that, hey, gold is still very much not a hot place to be yet. And of course, what you want is to be, buy the cold stuff. It's like Pilbara Minerals, which is a lithium company, had some huge bear markets. I mean, look at this one, 89% down. The lower it went, the longer it took. More and more people were willing to sell for reasons that makes no sense from a common sense perspective, because assuming this company would still be around and overall the sector, buying becomes exponentially better. So this was the worst sell and the worst buy. Again, you don't know that when we're here, you don't know that it's gonna go lower. You just know that if it goes lower, it's closer to the bottom, and the returns will be even higher, and the buying goes up exponentially. How long have I been? Okay, 36 minutes. Just wanted to touch on, one story as an example. It's like, okay, how do I quickly, or how do I think about, let's say, risk reward? We have Altamira, which is a Brazilian, it's a Canadian junior operating in Brazil, looking for gold and copper. Okay, what am I, let's say, how am I estimating this from a risk reward perspective? You might have seen the latest news releases. The latest news release about the Santa Helena project, that they're finding more evidence that there's a copper porphyry at depth. And I know they're doing more soil samples, and they're doing geophysical work down here, because I think they have like 4 copper targets in total, or 4 copper in soil anomalies that they're mapping and sampling and doing geophysics over. We know they had the Kajiro project, where they have like, how much gold do they have? Okay, it doesn't say here, but I think they have around 600,000 ounces. Maybe we can see. Let's say 700,000 ounces. So that's, semi margin of safety, since it's near surface. Metallurgy appears to be quite favorable. That they are doing more test work, metallurgical test work. So this could theoretically be a very low cost heap leach operation. Obviously, if gold went to 3,000, you could make a lot of money from a low capex operation, even at pretty decent, pretty low production levels, especially since, or relative to the market cap. Even if it costs like, I don't know, $5 million to get into production. I mean, if gold ripped and they could get this into production, they're doing, I think they're expecting an environmental permits to be, received relatively soon. I mean, if that happens, that's much closer to actually, I mean, then they could actually have a threat of monetizing it and go into, hopefully, very low capex, high margin production. So it's like, I would say it has quite a few facets to it. You have the Kajiro project, which also has the Maria Bonita target, which appears to be a snowline type target, meaning that it's a huge disseminated ore body that grades from 0.6 to 1 meter, starts at 1 gram per ton, starts at surface. They have no idea exactly how large it is yet, but you can see, I mean, the scale of this anomaly is huge. This is where they have 600 to 700,000 ounces, and they're doing permitting stuff, and are expecting environmental permit relatively soon. We don't know fully what this is. So this is one of the projects, and this project here contains, this is like the margin of safety kind of stuff. Sure, it's not a huge deposit, but it might be very low capex. Might be well, it appears, I think it's actually going to be permittable, that they could actually get permits, because that's far from a given in this day and age. So that could be, that's kind of the margin of safety aspect, even though again it's not huge. But, and of course, I mean, if this was 600,000-700,000 ounces out in the middle of nowhere in, I don't know, Alaska or something, and capex would be, it's like, yeah, they have no roads, they have no power lines nearby, etc. I mean, forget it. It doesn't matter if they have 600,000-700,000 ounces. You're never gonna build that. If it just the infrastructure alone costs like 200 million. This is close to power, close to roads, etc., etc., and they expect to hopefully have environmental permits relatively soon, or possibly soon. I should say possibly. But if they get that, all of a sudden this could be, and the metallurgical results that they're doing more work on comes back favorable. This is all of a sudden a threat. Monetization threat, that this actually has potentially real value. And if gold does well, etc., I mean, you could see a kind of a perfect storm there, especially if it I don't know, costs like, let's say metallurgical results are good, so it's like $5 million, and you could be in heap leach production, take saprolite and whatever. That's one aspect. Then you have the kind of blue sky and at least probable upside from exploration potential. You have the Maria Bonita, which they've already have some very good hits that many holes ended in mineralization. So we have no idea how deep the mineralization goes. I think it's wide open in every single direction and open at depth, given that the hole's bottom in mineralization. So we don't know. This might be, this might host, I have no idea, 500,000 ounces, 2 million ounces, 3 million ounces, 4, 5, 6, I don't know. But we know that the blue sky for now is wide open. And there is a scenario where this is a significant discovery, worth perhaps several hundred millions of dollars, if not more. We know that there is a scenario where it's like, for whatever reason, they end up finding almost nothing more. But you can do your own calculations. I haven't done it yet. But I mean, if you just take a square here and just 100 meters down or whatever, I mean, you come up with a respectable inventory of gold. And if that is heap leachable and it starts at surface, and you would have a potentially a very sweet strip ratio, etc., close to roads, close to power, yada yada, that could obviously be worth a lot. So what we know, the only thing we know at any given time is that, like I always say, sentiment will always change, and the price we're paying. So 28.65 market cap right now. What is priced in? What is priced in for Maria Bonita? Is this pricing in multi-million ounce discovery of heap leachable gold with low strip ratio that's near surface? Absolutely not. Is it pricing in this getting the necessary permits, etc., and potentially low capex, high margin production, even though, you know, at small scale. I would say not. Does it price in a rising gold price to go with that? Nope. Does it price in them finding something here? I mean, these are all placer workings, basically. No. Does it price in something here? Nope, I wouldn't say so. Does it price in the... Where's the latest news release? Here are the copper in soil anomalies, I think. Anomalies, CEU, yeah, copper anomalies. I mean, you can see quite a few anomalies here. This is where they believe, you see this kind of rounded pattern, that this might be a porphyry depth. Or is the stock price pricing in any or any success here? I wouldn't say so. And if you combined everything they have and you just divided per project, I mean, what is, let's say we have the production scenario is one thing at the Kajiro Central. Let's say, you know, a small scale 600,000-700,000 ounces mine, and that's not drilled out yet. I mean, that could be larger, obviously. It was like, okay, if we treat this as one project, we treat Maria Bonita as one project, and we treat the 4 copper anomalies as one single project, even though there's like 4 targets included in that project. So we have 3. In that case, there's like, let's say it's 30 million market cap, 10 million per project. So there's this, according to Mr. Market right now, you can buy this for 10 million, you can buy this for $10 million, and you can buy all the copper projects for $10 million. While what we know right now is Bonita might be, looks really, really good. Looks like it could be one of those deposits that could actually also become great mines, and obviously that's the only value of gold ounce in the ground is how much you make from it. The value of a mine is how much money you make from it. The better the margins are, the more it's worth, the more ounces, the more it's worth, etc. Now it's currently wide open in all directions and at depth. And let's say it's pricing in $10 million. What if this is a multi-million ounce? At the end of the day, they drill it some more, they extend it, and, you know, we can start like Snowline, which that's why I love these kind of stories. And I've talked about this before, and I described it extensively in my Snowline piece. There's so much more to an exploration play than it's just, hey, they can have this many ounces or whatever. I mean, think of the quick feedback you can have in systems like this. It's like Snowline. They have drilled, I don't know, 30, 40 holes or whatever at Valley. And all of us, already, you kind of know that, hey, these guys probably have at least 8 million ounces at Valley at good grades. From just, let's say, 40 holes. Whereas you can have like Osisko Mining up in Canada, which are drilling very deep, nuggety hard load gold mineralization. They have drilled over 1 million meters, probably up to 1.1 million meters. Possibly after the next drill campaign, we could see if, hey, this is, you know, at least 2 million ounces, let's say. Theoretically. Think about the quick payback there. I mean, you would obviously rather have, or let's say it's 4 million ounces, whatever, you know, I can't say conservative blue sky, but it's like, yeah, okay. It's possible that this is, let's say, 4 million ounces, whatever. You would obviously rather have an exploration story which could find that out in like 2 years rather than 6 to 7 years. Because the end result, I mean the final endowment is the same, but you have that value realization much quicker. Which is great from a compounding perspective, because I would rather create 500% in value in 2 years than in 6 to 7 years. And whatever happens with this, you still have this. And sure, it might not be, 600,000-700,000 ounces, like, who cares? But it's like gold gets going, let's say they get permits. Let's say they could build a mine for 5 million and possibly, mine some of this stuff, even though it's just a small scale operation. Because obviously, I mean, these are good grades, very near surface, which could also potentially be put on a heap leach. What could that generate in terms of value? And it's like, could they be self-funded, perhaps, and explore the copper targets and their other projects? Who knows? But that's one added avenue for upside. And you obviously have the copper anomalies. I love when you have, I mean, like I also said a bunch of times before, the market can only focus on one thing at any given time. So when you have a junior with multiple just look at Snowline. I mean, they have an absolutely enormous land package, huge amount of targets, and I would say 95% of the value priced in, or 95% of focus is on Valley. I wouldn't say that the Jupiter discovery plays a big part when people are buying and selling that. I think people are looking at Valley alone. Those stories are the best if there is potential in the other projects. Or look at Noah, for example. The market has a hard time figuring out what that is worth, and we don't know really what. I think that the market is mostly looking at a hemi potential, but still, if you have a junior with multiple projects, typically one of the projects might be priced in, and at a point in time like this where sentiment is piss poor, typically even the one project that the market focuses on can be bought at a discount. So if I had to say, my estimation from or for Altamira is that the market's focus is on Maria Bonita, but I think this is actually undervalued, even though if they only had Maria Bonita. That means I'm getting this for free, this for free, this for free, and the copper potential for free. So you get more upside. Well, your upside is diversified. If this works, it might make this look cheap. If this works really well, this will look very, very cheap. If they find a copper porphyry that's good, this will look very, very cheap. So it's kind of you're paying at a discount, I would say, to play this hand. But you get this hand for free, this hand for free, this hand for free, and the copper hands for free. That is what I love about juniors with multiple projects. On one hand, yes, it's frustrating because even though you can know that's like, hey, the sum of the parts in this junior, this should be 200% higher already if you valued each individual project, let's say. The market is never going to do that, typically. That's why the Landins have such a nice track record of as soon as they have a junior with like 2 good projects, like when they had NGX and that owned, I think they had that one had I think that had the assets that Philo Mining has now, and Philo Mining is worth $3 billion. It obviously didn't start out that way, but as soon as they spun out that, they took one company with multiple assets, spun out the company, gave that one of the assets to that company and land package, etc. Shareholders benefited enormously because it forced the market to appreciate the value in the project that was spun out, that had a 95% discount when it was tucked in behind the flagship project of the NGX vehicle as a whole. So it's kind of, you're stacking the odds in your favor. And in this case, even though the market might be thinking Maria Bonita is the only thing I care about, and I can't pay much attention to anything else, there is still a future where it's like Maria Bonita, let's say the mineralization stops everywhere. This huge anomaly here is, created from a small ore body, a relatively small ore body in the ground. You still have these kind of aces up the sleeve that the market is not caring about right now. So you have a diversification, internal diversification aspect, which brings some kind of margin of safety, and also brings diversification to the upside, which makes it a statistical margin of safety, that there's a greater chance that they will have something from having a lot of bullets in the chamber relative to one, even though the market is treating this as one bullet. So these juniors with multiple good-looking projects, they tend to be undervalued. Same, I talked about Headwater, for example. That's, in my opinion, outrageous how cheap that is. Same thing in play there. It's like, when they did the recent additional deal with Newcrest for like $2 million US guaranteed spending, and in a blue sky scenario they would find something with at least 1.5 million ounces equivalent, and Newcrest would fund that all the way up to PFS, including a PFS, which could cost tens of millions, and they would also give a royalty plus 25% ownership to Headwater. I don't think the price even went up that day. I don't think the price went up when they acquired that, announced that they acquired that project to begin with. How can you call this market rational? No, it's just the way it works with especially multi-asset juniors. They tend to be a lot cheaper. And the good thing obviously about take Headwater. If they just add on projects and make new deals, and they are still all kind of discounted by the market because the market only focuses on Spring Peak in for example, you're getting more and more diversification to the upside. If they had only Spring Peak would need to be a success for shareholders of Headwater to have a return. If the market is still only focusing on Spring Peak, but you have 6 other projects, meaning that you have in total, let's say, 7 bullets in the chamber, and you need one of those 7 to work out for you to have a very good return in Headwater. Obviously, the risk reward is immensely different. But the dumb market, which only focuses on one project, might be pricing those different vehicles at almost the same price. That is how obnoxiously stupid this market can become, or can be. Because humans have short attention spans and can only really focus on one thing at any given point. Look around at any junior out there with multiple assets. There will typically only be discussion about one project. Even though there might be more projects that all have value. It's like Magna mining, for example. Almost all the talk is about Green Hill. Even though I think the Shakespeare deposit and the Greater Shakespeare project obviously have value. And according to Mitsui a few years back, given the MOU with Mitsui suggested that the Shakespeare deposit alone, not even the Greater Shakespeare project, the deposit alone could at least be worth something between 66, I think, or 64 to 100 million Canadian. Let's see what the total enterprise value is for Magna Mining. I think they have 20 million in cash. So let's subtract that. So that's 96 million Canadian in enterprise value for Shakespeare, Greater Shakespeare, and Green Hill, plus all the things that have happened since the MOU, and given that both Shakespeare, they're finding stuff out at Shakespeare, positive surprises. Also, they have had great success at Green Hill, and they might have even made another discovery on the Green Hill ground, like a kilometer away from the current resource. Obviously value added stuff. But still today, one could say that Magna Mining is not even pricing in what Mitsui said that the Shakespeare deposit alone could be worth. This is just another point how dumb the market is, how much you can buy for free as a value investor and take advantage of how everybody else thinks and what they focus on. There is an enormous amount of value you can steal when we are below this black line here in this sector. And like I said, if you can find cases where, hey, this company has X amount of good looking projects or targets, and you know the market is only pricing in one of them, you get all of the other ones for free. So it's like, I mean, think about it. Let's say at a time like this, maybe you can find, let's say, well, yeah, let's put it like this. You have scenario A, where you have one asset, and it's selling at a 60% discount. Okay? Then you have scenario B, let's say 4 assets, including the previous one, the scenario A, and it's selling for, let's say, let's give the market some credit, 40% discount. Discount to the flagship. Yeah, this scenario A is a bit cheaper, but it's like, if you get 3 assets and pay just a little bit more, let's say 60% is priced in of the flagship asset in this case, and you get 3 other assets for free. I would say that's better than buying the one asset and getting buying it for 40%, 60% discount. Because if this fails, if this one asset company fails, you don't really, well, they don't have anything of value. This one, you pay a bit more, but you have 4 bullets in the chamber. So all would fail. And again, that assumes that these are legit assets. I mean, if you have a junior with there's some juniors with multiple projects, but you kind of know that, hey, these other projects are quite crap, or they won't do any work there for a long time, etc. Then the market wouldn't even really care if, let's say you have a 4-asset junior, they have one good project that's selling for cheap. If that fails and they have 3 crap assets left, that's not gonna, it's not gonna go to zero. That's at least good, but still, it's the market won't really care about that as much. It might trade they almost have nothing but a pipe dream. But my point is that I love to be able to buy as much as I can, to buy as much assets and value as I can for my invested dollars. So if I can get, I would rather buy ownership stake in 4 assets rather than 1 asset if I'm paying the same price for both types of vehicles, obviously. So I get 300% more assets for my dollar invested. So which goes to show that this sector is can be absolutely ridiculous. And there are some juniors out there that are cheap. There are some juniors out there that might be 300 or 400, 500% cheaper than the other cheap one. So this is not a time to be lazy and there's always differences. There's always stuff to do. Do the due diligence. And if you're a value hound, for example, there's ton of difference between 10 cheap juniors. They might be, all might be cheap, but one might be 100% cheaper, or at least 100% or hundreds of percent better risk reward than other. Because in this case, yes, this is a bit cheaper relative to the flagship asset, but in this one you get 3 other kicks at the can. So from a risk reward perspective, it's like Altamira. If you had, and I pretty much said it already, but it's if Altamira, if it only had Maria Bonita, and it would be trading close to the current price if it only had Maria Bonita. Compare that to an Altamira where you have all these projects and the copper ones. Again, you're paying kind of the same price. Obviously, I would much rather own ownership in 3 projects with X amount of targets than 1 target if I'm paying the same price. Because in scenario A, this has to work. In scenario B, this could work, this could work, this could work, this could work, these could work. So I'm leaving myself margin of safety in the form of I can be wrong on 1 target or look wrong. It's hard to say when you're wrong or not. But this can go south and this could still be a winner. Or this could go south and this could be a winner. Or both could work. And this could work and this could work. And none or all of these copper anomalies could work. Huge implication. Again, it's like you're paying this. It's like you're paying to play 1 hand, but you actually get to play 4 hands. That's great. Think about it. It's like It's like, yeah, it's like, yeah, I'm paying to play this hand, this pot, but I get to play three other hands, and they might 0 to 3 might also win. So I might lose the same amount, but I have a higher chance of winning some, and it's higher. The ultimate blue sky pot is much larger because there's still a possibility that 4 of the hands will win. 4 out of 4 hands will win. Huge implications from a risk-reward perspective. Even though the market, as always, doesn't factor that in. Again, that is why Lundins can just spin out an asset and all of a sudden shareholders gets hugely rewarded. No real value creation done. It's just that it forced the dumb market to actually appreciate the value that was already there. That's a case in point. There are huge biases in every investor, and all the things I've talked about affects myself as well. I mean, when I think of Magna Mining, I primarily think of Green Hill. You're always looking at the most exciting thing. Typically. But if you stay rational and think about it, you won't be, I'm not going to say fooled, but it's like you would consider everything. Like, okay, I'm paying this price and I'm getting all of that. Okay, that makes me bullish. But on a day-to-day basis, you will typically be bullish about one target or one asset. So it's not like you have to be absolutely immune, by distractions and not have tunnel vision, etc. It's just that you have to at least be aware that it happens and try to, again, always keep everything in mind. Don't look at the tree, see the forest at all times. So my preferred hunting ground, and that's obviously why you see these prospect generators, etc. They might have 30 projects and they're, priced like they, priced like they have the one project. Kennerland I think is a great example. I think they have like 32 million in cash and equities. So there's like 15 million left over for actual value reflection of all their projects. Partners will spend 29 million. Okay, 18 million. Yeah, and I don't remember exactly how much they have in equities, but it's just pretty obscene when you think about it. It's like if they have assets to the tune of like 32, so there's 15 over, and 19 million or so will be spent by, 29 will be spent by partners. One could say that, the market is pricing in that there is almost zero chance of any value creation happening, and that any of the projects they have is going to be worth anything at all, or like or let's say 1% of any of the projects to actually become a mine. And I have a hard time seeing that a company like, I think they have deals with Sumitomo and let's see here, Sumitomo, Newmont, Sumitomo, Senseium. It is absolutely crazy. I mean, this really might be one of the cheapest stocks around. I don't own much of it. I have it in the hodl portfolios. But it is literally impossible that you're overpaying. Literally impossible. 99.99%. Unless unless Newmont, Centerra and Sumitomo are absolutely brain dead. All three have to be absolutely brain dead for this to not be cheap. How often can you look at a company and say that? Of course, like always, there's no guarantees. This could be extremely cheap, but I wouldn't go all in simply because of that. Because there's still a scenario in the future where none of the projects work. It just means that you're paying way too little, so you would make way too... let's say, assuming one project works, you're gonna make more money than you should. Because there was so little chance of success priced in. That's basically it. That's why it's so hard when, again, people say, it's like, what's the best buy? It's like, I don't guarantee that any single junior I own will be a big success or I'll make money on it. I just know the ones that will be a success from these price levels will pay off more than they should, which means that I need an even lower hit rate than if all this sector was trading up here and everything was priced like this. Because significant discovery for any junior in this type of sentiment environment, when we go from, especially going into a sentiment high, might be 10 to 20 bags. A 10 to 20 bagger. While if we're priced up here, it might be 500, 5 to 7 bagger. So we're stacking the odds in our favor. We need less certainty down here because the ones that work will pay off much more than they should. I hope you get something out of this. Keep in mind, I am biased. If I talked about any companies, assume I own them. Think for yourselves. I think what I've said is, again, it's like super common sense stuff. I mean, like this. Since we know a downtrend always ends, we by definition know that if it didn't end here and it goes down, it's more probable that it ends the next day. But if it didn't end then, it's more probable this is the end. But if that's not the end, this is more probable. So you only know, really, that the more time and the lower it goes, by definition, the buys go up in value. And this is a much better buy than here. This is a better buy than here. And then one day, which we won't know when it actually happens, we won't know that until after, you will never see a better buy for maybe 6 years, let's say. So when this is gone, 6 years until you can get prices like that. This might have been the low. Personally, I think we've already seen the lows in the juniors, so I don't think we will be getting this cheap. But still, the lower these goes, the better the buys become anyway. So even though I can't get the ultimate buy, the closer it gets to it, the better the buy. So I mean, it's not it's not perfection we're after. I mean, just if your average was here, that's 300%. You don't need to go all in on the exact day. No, I mean, just from the black line here, that's like 126. Yeah, I mean, the future expected returns are getting absolutely retarded the longer we stray from the mean. Because we're gonna go, this sector never stops at fair value, it keeps going. And it doesn't stop to the downside either, it keeps going. Anyway, and just look how quickly, I mean, once this was over, it didn't take long until, you had months to be able to get superb buys. But once it bottomed, it just took a month, and then you couldn't buy cheaper You couldn't get better returns. You can't do it all over again. I mean, these buys here, you didn't see buys as good as that until 2015. So like you had to wait 7 years to get as good of an opportunity as you got here. That I cannot afford to miss these levels, because I don't know if it will be. I bought all the way down here. I'm buying now, so I don't know if maybe the prices will go something like this. And then maybe a blow off top, whatever. In that case, and then maybe. So who knows how long it is gonna take before I can get these kind of expected future returns like we're seeing now. I feel super blessed to be aware of this sector and to care about this sector when almost nobody's aware of it, and given the abysmal volumes, there's nobody in here buying, appreciating this opportunity. Almost nobody sees this as an opportunity. Nobody saw this as an opportunity, and that's why 95% of people never make any money, because they can't even have the common sense to buy cheap. And again, if you started buying up here, doesn't really matter. Selling at these levels, it's more of a mistake than buying here. I mean, even if you, I don't know, went all in around this level, I mean, here it's still, what, 22? I mean, we've had a year where you could add to your portfolio with much higher returns than expected up here. So even if you got a 15%, if you added 15% or whatever, or you did some value reshuffling, the past is the past. Doesn't matter. Doesn't matter if you're down 50% right now. All that's left is the future. All you can do is make the best possible decisions right now with the opportunities that you're given. What the Mr. Market is giving you, and you can decide, hey, okay, it's, too good of a price here, I'll buy that, and then maybe another story comes up and, oh, that's too cheap as well. Giving up or just being paralyzed, like, again, it's like, I won't be buying or selling down here. It's like, fine, don't do that. If you think holding is the most rational thing to do down here, then you don't know much. Selling, holding, and buying are miles apart down here. Absolutely miles apart. Selling is the most retarded thing you could ever do in the last 8 years. Holding is immensely better than doing the most retarded thing in 8 years. Not buying at the best possible point in the last 8 years is also retarded. Buying, holding, and selling at extremes are miles apart. If you're congratulating yourself for holding here, you're going to be outperformed by orders of magnitude over the long term versus the people, relative to the people that understood that buying is exponentially better than holding here. And of course, the one that sell are probably gonna, well, they're never gonna make any money unless they break that cycle. Anyway, thanks for listening. I don't know if Headwater is a sponsor. Altamira, I hope they could actually become a sponsor. I like this story. And I don't know how many more I mentioned. Magna Mining is a sponsor. Consider me biased. Make up your own opinion. Again, I don't share your losses or your profits. I'm not going to be there holding your hand throughout all this time. So it's like the quicker you learn to stand on your own legs, the better, because that's going to serve you forever. I don't know how long I'm going to be doing videos like this. So hopefully, if you're a part for the run, you're going to remember everything you learned and how it felt down here for the next time you go down here. Or you start like I don't feel like I have typically the time, but like preferably I would have knowledge about more sectors than gold and silver, and a bit about copper and nickel. Otherwise it's like, hey, if I knew oil and gas really well, I mean, if I could go back in time and buy those juniors when oil went negative, obviously I would want to do that. But I didn't really know enough about the companies to know what would be a good company, a good junior to buy. But like my results have shown, you can stick to one sector, but if you just stick to common sense and have infinite patience, unlike everyone else, over the long term you could make a lot of money in just one cyclical sector. Anyway, thanks a lot. Non-investing advice. Bye.